Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Types of Risk. Risk management is an essential component of strategic planning and operational execution across various sectors. Types of risk can be broadly categorized into several domains, each with distinct characteristics and implications for organizations. The primary types of risk include financial risk, operational risk, strategic risk, compliance risk, and reputational risk. Understanding these categories and their interdependencies enables professionals to devise effective risk management strategies. Financial risk refers to the potential loss of financial assets or income due to volatility in financial markets, credit defaults, or liquidity shortages. Common subtypes include market risk, credit risk, and liquidity risk. Market risk arises from fluctuations in market prices, such as interest rates, exchange rates, and equity prices. For instance, a sudden increase in interest rates can decrease the value of a bond portfolio. Credit risk involves the possibility that a borrower will default on their obligations, negatively impacting the lender. The 2008 financial crisis exemplified the catastrophic consequences of widespread credit risk, as mortgage-backed securities became worthless when borrowers defaulted en masse. Liquidity risk occurs when an entity cannot meet its short-term financial obligations due to an inability to convert assets into cash quickly. This type of risk was evident during the financial crisis when institutions struggled to sell off assets to cover their liabilities. Operational risk encompasses the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. This type of risk is pervasive across industries and can manifest in various forms, such as fraud, system failures, or natural disasters. For example, the infamous collapse of Barings Bank in 1995 was due to unauthorized trading activities by a single employee, highlighting the criticality of robust internal controls. Additionally, operational risk can arise from cyber threats, which have become increasingly prevalent as businesses rely more on digital infrastructure. The 2017 Equifax data breach, which exposed the personal information of over 147 million consumers, underscores the severe consequences of inadequate cybersecurity measures. Strategic risk is associated with the adverse effects on a company's objectives due to inadequate or poorly executed business strategies. This type of risk can stem from shifts in market demand, technological advancements, or competitive pressures. For instance, Kodak's failure to adapt to the digital photography revolution led to its eventual bankruptcy, illustrating how strategic missteps can jeopardize a company's survival. Companies must continuously assess their strategic positioning and adapt to changing market conditions to mitigate this risk. Furthermore, strategic risk can be exacerbated by mergers and acquisitions if due diligence is not thoroughly conducted, potentially leading to integration challenges and unforeseen liabilities. Compliance risk involves the potential for legal or regulatory sanctions, financial forfeiture, or reputational harm due to noncompliance with laws, regulations, or internal policies. This type of risk is particularly salient in highly regulated industries such as finance, healthcare, and pharmaceuticals. For example, in 2012, HSBC faced a $1.9 billion fine for failing to prevent money laundering activities, demonstrating the severe repercussions of compliance failures. Organizations must implement comprehensive compliance programs and stay abreast of regulatory changes to avoid such penalties. Moreover, compliance risk can also arise from international operations, where differing regulatory environments and cultural norms complicate adherence to global standards. Reputational risk pertains to the potential loss of stakeholder trust and confidence due to negative public perception or adverse events. This type of risk can result from poor product quality, unethical behavior, or negative media coverage. The Volkswagen emissions scandal, where the company admitted to cheating on emissions tests, significantly damaged its reputation and led to substantial financial losses. Reputational risk is inherently interconnected with other types of risk, as financial mismanagement, operational failures, strategic blunders, or compliance breaches can all tarnish an organization's reputation. Effective communication and crisis management are crucial in mitigating the impact of reputational damage. Each type of risk requires tailored management strategies to address its unique characteristics and implications. Financial risk management often involves the use of hedging techniques, such as derivatives, to mitigate exposure to market fluctuations. Credit risk can be managed through rigorous credit assessments, diversification of credit portfolios, and the use of credit derivatives. Liquidity risk management focuses on maintaining adequate cash reserves and access to credit lines to ensure solvency during periods of financial stress. Operational risk management necessitates robust internal controls, employee training, and disaster recovery plans to address potential failures in processes, systems, or personnel. Cybersecurity measures such as encryption, intrusion detection systems, and regular security audits are critical in mitigating cyber threats. Additionally, fostering a risk-aware culture within the organization encourages proactive identification and management of operational risks. Strategic risk management involves continuous market analysis, scenario planning, and strategic agility to adapt to changing conditions. Companies must regularly review and update their business strategies to align with evolving market demands and technological advancements. Mergers and acquisitions should be approached with thorough due diligence to identify potential risks and integration challenges. Compliance risk management requires comprehensive compliance programs, regular audits, and ongoing training to ensure adherence to legal and regulatory requirements. Organizations must stay informed of regulatory changes and engage with regulatory bodies to anticipate and address compliance challenges. International operations necessitate a nuanced understanding of local regulations and cultural practices to mitigate compliance risks. Reputational risk management focuses on maintaining high ethical standards, transparent communication, and effective crisis management. Organizations should establish protocols for addressing negative events and engaging with stakeholders to rebuild trust. Proactive reputation management, such as corporate social responsibility initiatives and positive media relations, can also enhance an organization's public image. In conclusion, understanding the various types of risk is fundamental to effective risk management. Each type of risk, whether financial, operational, strategic, compliance, or reputational, presents unique challenges and requires specific management strategies. By comprehensively addressing these risks, organizations can protect their assets, ensure regulatory compliance, and maintain stakeholder trust. The integration of robust risk management practices into organizational strategies is essential for sustaining long-term success and resilience in an increasingly complex and dynamic environment. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.